Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything personal finance related, whether it's mutual fund news or strategies that you can employ. First up, in mutual fund news, let me tell you that there's an interesting development from the house of ICICI Prudential AMC. They've just announced that they are reopening subscriptions into their small cap fund. And this is a pretty big deal because they took a call and they said they are known to be contrarian, but when everybody else was accepting a lot of inflows into their small cap fund, they stopped. And they said, look, we don't think that the valuations are sustainable at this point. For them, as a fund house, to start receiving those subscriptions once again is a statement of intent. And of course, it's one fund house, so bear that in mind. But it is a reasonably big development. Remember that their assets under management are not the largest in the space, just over 8,000 odd crore rupees. And the largest, of course, as you know, is Nippon Small Cap Actively Managed Fund. So, and the difference is quite substantial. It's an important development. Talk to your advisor before you take a decision. Now, the topic that I've chosen in the first part of this conversation is on the taking of a home loan. What are the prevailing rates? What do you need to bear in mind when you are out shopping for a loan? And is this the moment to reprice your loan, if at all? I'm joined by Adil Shetty, the Chief Executive Officer of bankbazaar.com. Adil, thanks as always for taking the time. Let me start by asking you about the prevailing rates. We've had several rate cuts already. Has that already been transmitted across the board, or are we still waiting for more transmission? Of course, new rates or new loans are always priced at the bottom. What are the rates right now?
So Alex, the good news is, when we were talking a year ago, we were talking about loans at, 8.25%, 8.5%. So now, right, the prevailing rates for home loans, obviously depending on your credit score, and that's why, we always tell you to track and improve your credit score when anyone comes to Bank Bazaar. But for a person with a high credit score, the prevailing rates currently are between 7.25% and let's say 7.75, 7.8%. So the range is between 7.25 and 7.8%. But keep in mind, right, there are few lenders I'm seeing in the market today who are even going as low as 7.1%. But when I look at the big lenders out there, the big mortgage home loan lenders, the range is operating between 7.25% and 7.8%.
So these are people like State Bank of India, these are people like HDFC Bank, I would think, and a few more other mortgage lenders, right?
That's right. Those are where the big guys are at. But I do see a few offers, right, under very high credit score, over 800, for particular loan amounts less than 30 lakhs, right? I'm also seeing an offer at 7.1%. But let me answer the larger question you asked, Alex. Is this a good time, and has the transmission passed? So the answer on both questions is yes. I think if anyone is either thinking of a new home loan, I have not seen in many, many years, right, rates close to that 7% number. The rates might continue to go down because we are expecting that there will be further repo rate cuts given how low inflation is. But it's a good time to lock in, because even if you lock in today at 7.25, even if you lock in and the rate falls by 0.25%, because all loans today are repo linked loans, automatically the benefit will flow to you. So don't wait, lock in at 7.25. If the rates fall, automatically the benefit will come to you. And if you are someone who's paying more than 8%, 8.5% on your home loan, this is a good time to be considering a refinance too.
Okay, let me ask about that, right? Because Adil, the knowledge is that these are all floating rate loans. These mortgage loans are all floating rate loans. There are fixed rate loans, but there are preconditions involved, right? They're not truly fixed rate, are they?
Yeah, so fixed rate loans in India, are quite rare because most people and most banks prefer to do a floating rate loan because you don't have to predict the future. So if the rate goes up, the EMI goes up. If the rate goes down, the EMI goes down. So 95%, Alex, of home loans in India are floating rate loans. The challenge with a fixed rate loan, right, is it's typically not fixed for 20 years. So it might be fixed for 3 years and then, it starts floating. And because there's a risk, right, usually that risk is passed to the consumer in terms of a higher spread. So if I can get a floating rate loan between 7.25 and 7.75%, a fixed rate loan will probably be 1% or 1.5% higher. because the risk is being transferred to the borrower. So I think everyone listening to this show is probably, and people like you and me, thinking about a floating rate loan. That's 95% of the market.
Yeah, that's a fair point, because ultimately you'd be locking it at a higher rate. Even if rates go up, they will go up after a period of time. One would assume that we're not yet at the bottom of the cycle. We may not see a rate cut in the next policy meeting, but the assumption is that you could see at least another 25 basis point cut and then a pause for quite a while. But who knows, with geopolitics where it is at and monetary policy, you can't predict these things. Having said that, let's talk about the size of a loan and also how that determines or affects pricing, and the tenor. What is the sweet spot in terms of the information that you've gathered, Adil, over the years?
So, see, in terms of size of a loan, right, we typically ballpark recommend that you should be able to service that from your income. So the ballpark we recommend is ideally maybe, 30-35% of your monthly income. Net income can go towards your EMI or home loan obligation. Now, this is a rule of thumb, right? Because all of us probably will end up buying a house which is slightly above what we expected. So the number can go up or down, Alex, but a sweet spot for what is the size of loan you should take is probably about 35% EMI. The 35% of your disposable income should cover your EMI. The sweet spot in terms of tenor, right? See, the easy answer here, Alex, it's difficult to execute, but easy answer is try and pay off your loan in as less years as possible. And I'll just give you an illustrative example. So, and I'm using an example of, let's say, a home loan, which is at 8.5%, but this is valid at all rates. On a 30-year loan, right, to take your outstanding principal to half of what you start, on a 30-year loan, right, you take 273 months to get your principal down to half. Now, on a 10-year loan, right, you take 73 months to get to the same half of outstanding principal. So the faster you pay your loan, and this is connected to what we tell people to prepay, is it really helps, right? And I'll give you another quick rule of thumb, which we users find very interesting at Bank Bazaar. If you prepay 5% of your outstanding loan every year, a 20-year loan is paid off in 12 years. Can you imagine, right? A 20-year loan is paid off in 12 years. Every year you just pay 5% prepayment on your outstanding loan. So the tenor is do as less as you can, but keep in mind for the same loan amount, if your tenor is lower, your EMI is higher. But I'd say the sweet spot in India is, a 15, 20-year home loan is acceptable.
The one thing that a lot of people, of course, know, and they'll say that it's basic math, but an equal number of people don't know is that if you have the option between raising your EMI and raising your tenor, you should almost always raise your EMI if you can afford it, because you will be paying more interest over a longer tenor. In your experience, do enough people know this, Adil?
Yeah, so enough people actually don't know this, Alex, but one good thing which has happened, right? And let me just put numbers to this, so we're talking about real things over here. So the repo rate has been cut 1.25%. Now let's put numbers to it. What does 1.25%, right, make in these two options? So one option is keeping your EMI the same and reducing the period or the tenor. The other is let your EMI go down but keep the same tenor. On a 50 lakh loan, Alex, 20 years loan, which is average that we're looking at, if you reduce your EMI because of a 1.25% cut in the last 12 months, you save 9.2 lakhs in EMI. Keep that number in mind, you save 9.2 lakhs. But if you do what we call a Bank Bazaar switch hit, right? So take the lower amount, but keep your EMI same, you save 18 lakhs, Alex. Double the saving in interest outflow by keeping the EMI the same. So it's very important you keep this in mind. But here's the good news, Alex. The default option banks are offering, and this is what, the RBI has said, that you have to give all options to the consumer, reduce the EMI, reduce the tenor. But most banks typically offer a default option of reducing the tenor. So even if you do nothing, Alex, even if you do nothing, when your reset happens in some loans, if repo rate falls, tomorrow you get a lower EMI. In some loans, it might take a month. In some loans, it might take 3 months. But and assuming you're on a repo loan, because a lot of people are still on a base rate or MCLR, which is a separate topic. But the good news is the default option most banks offer is your tenor goes down, and that maximizes your interest outflow savings.
But equally on the other side, Adil, when the interest rates go up, if the default option is your tenor goes up, then that's not a good thing, is it?
That's also true, Alex. Everything cuts both ways. So, someone might be happy, like I'm happy, right? That today there's a loan a bank offers where tomorrow your EMI goes down. Tomorrow, right? It's called T+0, right? But when the rate goes up, the same thing comes back to hit you. So yeah, everything cuts two ways.
This is a little bit of a different question, but Adil, if I look back at the last 20 years or so, generally people tend to gravitate towards taking these house loan decisions when interest rates are lower. But then there are periods of two and a half years where you have that peak and trough, right? Where interest rates shift either way. The average that you pay is actually significantly higher, isn't it?
Yeah, absolutely right, Alex. I think a lot of viewers might not believe this, but you and I have been doing this for 20 years now. So 20 years is not beyond our memory. We've been tracking home loans. I've been doing it at Bank Bazaar. So the interesting thing, Alex, is the RBI has done such a fantastic job that you don't have to worry about if the rate goes up or down, because you are protected. If the rate goes down, it comes to you. If the rate goes up, you also have to pay for it. But that's automatic. I think the important thing now is what is the spread you're paying above the repo rate. So let me just give you an example. Today, let's say the repo rate is 5.25%. If you take a home loan at 7.25%, your spread is 2%. So for the next 20 years, your spread is 2%, right? But if you get an opportunity where the spread falls to 1.5%, you should capture it. So the RBI has simplified our life in a way that we don't have to worry at what the repo is, because the benefit will flow to us. A simple example is today I should not think twice about taking at 7.25%, because if the repo rate falls, the benefit will come to me immediately. Don't even think about taking the loan. But the important thing is today I also have to be aware what is the spread I'm paying, because I know people paying 2% spread. I know people paying 2.5% spread. I know people paying 3% spread. So the world has become simpler, but it has also become slightly more intricate, which we need to keep track of.
Yeah, important points that you're raising. Adil, thanks so much for taking the time today. A pleasure speaking with you as always.